My name's Crystal, and my husband and I are the owners of First String Bookkeeping Co. Are you a business owner and you really want your business to be successful, but when you look at the numbers, you get so confused and totally stressed out? Well, then I hope you'll keep watching, because our goal at First String Bookkeeping Co. is to help you feel more confident when it comes to your business's finances. That's why we put out these videos, to give you guys bite-sized bits of information that will make understanding your books so much easier. In our first two videos, we talked about the income statement and statement of owner's equity. Today, we're going to talk about the balance sheet. It's also known as the statement of financial position. It's given these two names because one, the balance sheet always has to be in balance. We'll talk about that in a future video. And two, because unlike the income statement and statement of owner's equity, which are generated for a period of time, the balance sheet is generated for a point in time. So it shows the company's financial position as of a particular date. Essentially, the balance sheet shows your company's assets and the claims against those assets as of a particular point in time. The three reports that we've talked about so far are generally looked at in this order: income statement, statement of owner's equity, and then balance sheet, because the information from one leads to the next. For example, the net profit or net loss from the income statement goes onto the statement of owner's equity. And then the ending owner's equity from the statement of owner's equity goes onto the balance sheet. Last week, we talked about equity, which are the rights or financial claims to the assets of your company. More specifically, we talked about owner's equity. Of course, owners can have equity in their company, but others can as well. The second type of person that can have equity or claims to the assets of your company are creditors. Creditors are individuals or companies that you owe money to. It's shown on your balance sheet as a liability. Since you are in debt to them, they have a financial claim to the assets of your company until that debt is paid off. The balance sheet starts out by listing all of your company's assets. So remember, assets are things of value that your company owns. Things like cash, money in your checking or savings account, vehicles, equipment, supplies, buildings, land, and so on. Then it lists any liabilities that your company has. So liabilities are obligations that come due in the future, usually with a monetary implication. Liabilities include things like loans, vehicle leases, mortgages, credit cards, bills that you've received but haven't paid yet, and wages you owe to your staff. The liabilities show the creditor's claims to the assets of your company. And lastly, the balance sheet shows your owner's equity, which we get from the ending balance on the statement of owner's equity. I hope you guys found this helpful. Please let me know if you have any questions, and I'll see you next week.